You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the podcast. Hope you all had a great week and that you're doing well. I thought that today I would go over a conversation I had with a client recently. Thought maybe it would help some of you. So I just planned to really talk out what we went through and share what he was going through, this particular client. He was about to pay his premium and he decided to forego paying the paid-up additions for the current year because he said, I think instead I will focus on paying down my mortgage. I think I'm going to send roughly $1,000 a month to my mortgage to get that house paid down faster. Part of the reason why he wanted to do that is because he has a higher interest rate than he would like since he bought the house about 6 months ago. And so he wanted to be able to pay it down and then refinance it as soon as possible or a few years so that he could get that lower interest rate. And so he was going to redirect money that was supposed to go that could have gone into the paid-up additions and instead direct that to his mortgage. So now remember, refinancing will restart the first 10 years of your mortgage where the majority of your payment is interest. So he would have paid mostly interest up until the time he refinances the loan and then restart the ugly time period again where his mortgage is primarily all interest. What does the interest rate even mean when you end up paying twice the cost of your house in the end? Wouldn't that be more like 50% interest rather than whatever rate you're being told that you have on your mortgage or whatever rate you have? Nelson always said it's about the volume of interest that you're paying, not the interest rate. And so most of you, I'm sure, know that my perspective is that it's not always the best thing to pay down your house or focus on paying down your house. Now, if you plan to live there the rest of your life or rent it out, use it as a rental property, if you just plan to keep the house for your lifetime and you just want the house paid off and you don't want to have to deal with a house payment forever, then I think you should do whatever helps you sleep at night. If you think that it'll be best just to get rid of that house payment and not have to worry about it anymore so you don't have that cash flow going towards that, then by all means do what you think is best for your family. In most cases, I feel like it would be better instead of shoving all that money towards the house, that it would be better to redirect that money and to put it in something else. I don't know, maybe a whole life policy. So put it in something like a whole life policy where it's going to be able to capture the earning power of those dollars for the rest of your life and be growing a cash value that you can use for whatever purpose, including paying off your house or paying down your house if you so choose at some future time. But until then, you have access to the cash, you have use of the cash. Cash is king, you can't go wrong with that. Maybe another opportunity pops up that you decide, oh, I'm glad I didn't focus all my dollars on paying down the house. Now I can use my dollars for this other thing or other investment. Another way to look at it is if you were to go ahead and focus that money on paying down your house and you're actively paying it down and you're doing a good job, and then the housing market goes down at the particular time when you need to sell or that you want to sell. If it happens to go below your purchase price, and meanwhile, you've been actively trying to pay down the mortgage, so you've been sinking all your money into the house, and then that goes down in value, you just may end up not getting that money back. You may have put all that money into your house and lost equity and then not get all your money back. Now, I know that in general, housing usually goes up, so that may not be a problem or may not happen for you or may not be a concern of yours, but I just wanted to put that out there as a possibility. You just never know. And as you build the equity in your house, I'm sure it feels exciting. Like, wow, I only owe this much. My house is going up in value. That's really great. But keep in mind that you do not earn anything on your equity. Your equity is not earning for you. You're going to have that equity one way or the other. So if it's going to increase, that's great, but it's not earning anything. And so you could be putting those dollars into something that will be earning for you. As it turns out, this client already had an existing policy, the one he was trying to decide whether or not to fund his paid up additions, and he's had it for some years already. And so he already has about $73,000 in his policy. So I said, if you really are determined and you want to pay down your house, we can use this money that's already inside your account and just take some of it, half of it, three-quarters of it, all of it, whatever you want, and put down on your principal right now. Because the way you were going to do it was to put 1,000 down extra every month, and it would take about 6 years for him to get to the point with the money you already had now. So I said, you could just take the whole amount you have now, plop it down on your principal, and basically trade out that chunk of money's worth of interest that you're paying at the higher rate. It was a little bit close to 7%, about 7%, and trade that rate for your life insurance loan rate, which is at 5% for him. Some of the older contracts are at 5%, even older with different companies, you might get up to 8%. And a lot of them are variable, so they're changing. But he has a fixed rate option at 5%. And that same contract for newer contracts is currently at 4%, guaranteed for the rest of your life once you actually acquire that contract. So for him, his guaranteed lifetime rate is 5%. And so he can swap out $73,000 worth that's currently at almost 7 and swap it out for 5 and then shorten the time period for him to get that money in. And I said, instead, you can redirect that extra 1,000. You can put part of it towards your loan repayment for the money you just borrowed and part of it towards a policy on your spouse that he's been wanting to start but hasn't started yet for her. He could even choose to pay interest only on the loan repayment to his policy while he takes some time, a few years maybe, to beef up a policy on his spouse since he started hers many years later, it'd be about 7 or 8 years later than his own policy. He could do that and then boost hers up a little bit and then remove some funding from her policy and redirect it back to his, either the loan repayment, paid up additions. Of course, we want to be honest bankers. And so it will be good for him to pay himself back with interest, any loans that he takes. But you just have that flexibility. Makes it a lot easier when you're trying to make these decisions, knowing you have that flexibility. And if along the way, he decides he doesn't have as much money, there's a layoff or some sort of reason why they bringing in less income or have higher expenses, he can always reduce down the paid up additions for her new contract or his contract. His paid up additions will likely have to come off at a few more years. Not really sure. I don't remember exactly how many years on this contract, but at some point, those paid up additions will have to drop off. And then he can focus on hers or on the loan, the mortgage repayment, the loan repayment, the mortgage that he moved over to his whole life policy. He can focus on repaying that loan at that future time. You just have all the flexibility that you need or could want. So when I started the conversation with this person, he was really determined. He wanted to send that extra money to the mortgage. He also just wanted to understand my perspective. And so we had a conversation. And by the end, he decided, never mind, scratch that. I think I'd rather fund another whole life, focus more on paid petitions if I can for my contract and for a new contract. And then he's still trying to decide if he wants to use a lump sum loan from his current policy and pay down the mortgage right away and really make a bigger hit faster. And so that's just one of the cool things. There's so many. One of the cool things that you can do with a banking system that you have set up using a whole life policy to run your funds through and capture that earning power. You're able to capture as much earning power of your dollars before you spend them, even when you're paying down outside debts, even large debts like a mortgage. We also went over how he could borrow those funds, pay it down on his house, pay himself back in 10 years, and a projection of just how much those funds would have earned for him, the funds that he borrowed out and paid down the house, how much they would have earned for him in that 10 years. And so it was close to 30,000 what he would have earned on that money by leaving it in the policy and borrowing against it to pay down the house. He would have earned about 30,000 over what he would have spent in interest as a projection. But that was only over 10 years, the projection I was sharing with him. What about 50 years? Because he's young, he's in his 30s. How would that look leaving that 73,000 in there to earn your contractual guaranteed crediting rate and also the dividends, which then also earn a contractual guaranteed crediting rate? and having that grow there for the next 50 years. I mean, it's going to be amazing. You're going to be real glad that you made that decision. And just think if he had actually funded higher when he had the opportunity to fund for his wife or fund more into his paid petitions, if he would have an even larger pool of cash right now that he could have paid towards a mortgage if he wanted to and captured that earning power for the rest of his years, would have been even better. Anyhow, I just thought I would share that client conversation that I had recently. I thought it was interesting enough to share with you all and would help you in some way. If this is sounding like something you want to get started so that you have that option or opportunity in your future to take over a mortgage or whatever other debt you're trying to take over, whether it's a small business loan or loans for your small business, different loans with different banks or cars or credit card debt, whatever it is, school loans, we can take it over with your banking policy and capture the earning power of those dollars that are currently slipping through your fingers. If you'd like to look into that for yourself, if you're ready to become your own banker and start the infinite banking concept for yourself, and you'd like to partner with me as your advisor, please reach out. I'd be happy to talk with you and happy to help you. You can reach me at Valerie@alphaomegawealth.com. Thanks so much for listening as always, and I hope you have a wonderful week. Take care.